A wave of selling swept across global financial markets today, Friday, November 21, 2025, sending shockwaves through trading floors and investment houses around the world. The mood was tense and uncertain, as investors scrambled to make sense of the sudden downturn and protect their portfolios from further losses. From the bustling markets of Tokyo to the financial centers of Taipei, a trail of red ink marked the day's trading, with losses mounting by the hour, and traders glued to their screens in disbelief. Asian stocks took a significant hit, extending a sharp downturn that began on Wall Street overnight. The sell-off quickly gained momentum, as negative sentiment spread and investors rushed to exit positions, fearing deeper losses ahead. This broad-based rout signals growing investor anxiety about the global economy. Concerns about slowing growth, persistent inflation, and the possibility of central banks tightening monetary policy have all contributed to the nervous atmosphere. Investors are quickly shedding riskier assets and seeking safer havens, a classic risk-off event. Gold, US dollars, and government bonds are suddenly in high demand as people look for stability amid the chaos. The anxiety that gripped Asia is now spreading westward, with European markets set to open sharply lower. Early indicators suggest that the sell-off will continue, as traders in London, Paris, and Frankfurt brace for another volatile session. Much of the uncertainty stems from questions about future interest rate hikes by major central banks, especially the U.S. Federal Reserve. Investors are worried that higher borrowing costs could choke off economic growth and trigger a global slowdown. Underlying concerns, uncertainty over interest rates, fears of an economic slowdown, and overvalued markets are driving this synchronized sell-off. Analysts warn that markets may remain volatile in the days ahead as new data and policy signals emerge. The MSCI's broadest index of Asia-Pacific shares outside Japan plunged 2.2% today, on track for its worst week since April. The scale and speed of the decline have caught many by surprise. Losses are significant and widespread, affecting nearly every major market in the region. From technology giants to manufacturing firms, few sectors have been spared from the sell-off. For everyday people, this means a drop in the value of retirement accounts and investment portfolios. Many are left wondering how long the turmoil will last and what it could mean for their financial future. It's a stark reminder of how interconnected our global financial system has become, where a shock in one region can quickly ripple across continents, impacting economies and individuals everywhere. At the heart of today's turmoil is the U.S. September Jobs Report, a document that investors and policymakers alike have been anxiously awaiting. This monthly report is often seen as a key indicator of the nation's economic health, and its findings can send ripples through global markets. But this time, the report delivered more confusion than clarity, leaving many market participants scratching their heads and searching for answers. The economy added more jobs than expected, which would normally be a sign of strength. However, the unemployment rate ticked up to 4.4%, a level not seen in over a year, and previous job gains were revised downward, casting doubt on the robustness of the labor market. These conflicting signals have made it difficult for analysts to determine whether the economy is truly gaining momentum or starting to lose steam. This mixed message left investors uncertain about the Federal Reserve's next move on interest rates, as every data point now seems to carry extra weight in shaping expectations. Futures markets now see a 40% chance of a rate cut in December, up from 30% the day before. This shift reflects how quickly sentiment can change in response to new information. However, Fed officials have warned against cutting rates too soon, citing persistent risks of inflation and the potential for financial instability if policy is loosened prematurely. This disconnect between market hopes and central bank caution is fueling volatility, as investors try to anticipate the Fed's next move while grappling with mixed economic signals. Investors are hoping for a rate cut to boost markets and ease borrowing costs, but the Fed remains focused on keeping inflation in check and preventing asset bubbles. The result is a tense standoff, with heightened market swings and a sense of unease hanging over Wall Street. In this environment, uncertainty remains the market's biggest enemy, making it harder for investors to chart a clear path forward. U.S. technology stocks have led the recent market sell-off, sending shockwaves through Wall Street and beyond. Despite the sector's reputation for resilience and innovation, even the biggest names haven't been spared from the downturn. This comes even as tech giants like Nvidia report blockbuster earnings, beating analyst expectations, and posting record profits. In any other environment, such results would have sent shares soaring. But right now, even the best news isn't enough to reassure nervous investors. The Nasdaq saw its widest one-day swing since April, a dramatic reminder that markets can be unpredictable. Even stellar profits can't calm broader economic fears, as investors worry about inflation, interest rates, and the possibility of a recession. Many tech stocks have soared to bubble-like valuations over the past year, fueled by optimism about artificial intelligence and digital transformation. But when sentiment shifts, these high-flying stocks can fall just as quickly as they rose, leaving investors exposed to sudden losses. That's why many investors are locking in profits now, choosing to sell while prices are still high. There's a growing fear that the bubble might burst, and no one wants to be left holding the bag if the market takes a turn for the worse. Think of it like a hot air balloon. Strong earnings and innovation act as the hot air, pushing valuations higher and higher, lifting the entire sector above the clouds. But when economic uncertainty and global headwinds hit, the ride becomes risky and unpredictable. The higher the balloon, the harder the fall if things go wrong. That's why we're seeing tech stocks tumble, even as companies announce positive news. The market is driven by fear as much as by facts. And right now, anxiety is winning out. The tech downturn on Wall Street doesn't stay contained. It quickly ripples across Asia, where economies are deeply tied to the global tech supply chain. What happens in New York can be felt in Seoul, Taipei, and beyond within hours. When the Nasdaq falls, investors in Taiwan and South Korea, home to major tech manufacturers, rush to sell, fearing that falling demand in the US will hit their own markets hard. The US tech sell-off is more than just a local event. It's a warning sign for Asian markets, signaling that global demand for technology products could be at risk. Heavy selling in Taiwan and South Korea reflects deep concerns about a rough landing for the sector. Investors are bracing for more volatility, uncertain about when stability will return. The global tech cycle, once a source of steady growth, is now a source of volatility everywhere. As markets react to every headline, investors around the world are left wondering, when will good news finally be good enough? Wall Street's tech tumble and the US jobs report sent shockwaves through Asia. Japan's Nikkei dropped 2.2%, capping a tough week. Investors fear a US slowdown will hurt Japanese exports. Taiwan's main index plunged 3.4% as investors dumped shares of key tech suppliers. South Korea's market fell 3.7%, reflecting its reliance on tech exports. The scale of these drops shows how sensitive Asian markets are to global tech sentiment. China's CSI 300 and Hong Kong's Hang Seng each fell 1.5%, reflecting broader growth concerns. China faces its own challenges, including a property crisis and weak consumer demand. A global slowdown would only add to these pressures. The region's markets are feeling the full force of global uncertainty. As Japan's stock market tumbled, its government unveiled a massive stimulus package worth over $135 billion. The goal jumpstart an economy struggling with slow growth. But Japan faces a weakened yen, trading near a 10-month low. A weak yen helps exporters but raises import costs, fueling inflation and squeezing consumers. The government may intervene to support the currency, adding more uncertainty. Meanwhile, rising consumer prices keep pressure on the Bank of Japan to consider raising interest rates. Policymakers are caught between stimulating growth and fighting inflation. The bond market is reacting, with yields falling from recent highs. Japan's economic balancing act is growing more complex. Every move is being watched by global investors. China and Hong Kong's markets fell as investors grappled with domestic and global challenges. China's property crisis and weak consumer demand are dragging on recovery. Major developers are defaulting, and stalled construction is hurting confidence. Hong Kong's market, closely tied to mainland China, is also feeling the pain. The 1.5% drop in the Hang Seng reflects these pressures. Beijing's stimulus efforts have yet to fully revive growth. A potential US slowdown could complicate China's recovery further. Weakness in China means weaker demand worldwide, rippling through global markets. The market turmoil hit commodities too. Oil and gold both moved sharply. US crude oil fell 1.2%, on track for a 3% weekly loss, signaling fears of weaker global growth. Hopes for peace between Ukraine and Russia could boost energy supplies, pushing oil prices lower. For consumers, cheaper oil means lower gas prices, but for the economy, it's a warning sign. Gold, usually a safe haven, dipped 0.5% to $4,055 an ounce. Investors may be selling gold to raise cash amid broader losses. Despite the dip, gold remains historically high, reflecting deep market anxiety. These moves in oil and gold offer clues about investor expectations. Commodities are echoing the uncertainty gripping global markets. For anyone with investments, days like this are unsettling. Market volatility is normal. Stocks go up and down. The key is not to panic or make rash decisions that lock in losses. Today's swings are driven by uncertainty over the economy and interest rates. Higher rates can hurt stocks but help savers. Lower rates do the opposite. Review your financial situation and risk tolerance. Long-term investors can usually ride out volatility. Those near retirement may want a more conservative mix. Diversification is your best defense against market swings. Global events show how interconnected your finances are with the world. Staying informed and sticking to a long-term plan is the best way forward. As the dust settles, the big question is, what's next? Uncertainty over the Federal Reserve's interest rate path remains unresolved. Markets will stay volatile until there's clarity on the U.S. economy's direction. Tech sector valuations and global policy responses will be closely watched. Japan and China face their own challenges, and their actions will impact global markets. The world's economies are deeply interconnected. For individuals, this is a time for caution and discipline. Review your goals, diversify, and avoid emotional reactions. With patience and a long-term strategy, you can weather the storm and prepare for recovery.